Hello, everybody, and welcome to the inaugural webinar series. Today, we'll focus on navigating the U.S. hotel industry in 2024. I'm delighted to see such a strong turnout for our first session, and I'm excited to embark on this exciting journey with all of you. My name is Rav Singh with Singh Commercial Group. I'll be your host for today's discussion. With the focus on buying and selling hotels in the commercial real estate brokerage, and also the owner of private equity firm specializing in raising capital and providing passive returns to investors, I'm passionate about exploring the nuances of the hospitality industry. I'm the National Hospitality Division leader at KW Commercial, full service brokerage, which is headquartered in Austin, Texas, with market centers in 55 countries, including US and Canada, and close to 3,000 commercial agents in the brokerage. So, why is there a purpose for these webinar series? Our goal with these webinars is to create an engaging platform where industry experts, professionals, agents, and brokers can come together. We aim to facilitate insightful discussions on our latest trends, innovative strategies, and emerging opportunities in the hotel industry. I'm tasked at my brokerage to do mastermind calls on a monthly basis. So today I thought that it would be a really good idea to bring in the community within the mastermind calls that I do. So that way we can have an engaging discussion regarding the hospitality industry. So the format is going to be pretty simple. First, I'm going to introduce Mr. Sherman, who will be sharing his slides with us. He'll be providing an overview of the state of the hospitality industry in 2024. Following his presentation, we'll transition into a one-on-one discussion about the industry where we'll pose questions and hopefully have an engaging discussion with Mr. Sherman. During this discussion, I encourage each of you to utilize the chat feature and ask questions, share your thoughts, engage with the conversation. Your inputs is invaluable, and we look forward to addressing some of the queries during the dedicated Q&A segment. So today, we have the privilege of being joined by our distinguished guest speaker, Mr. Colin Sherman. Mr. Sherman is the Director of Hospitality Analytics from the CoStar Group, overseeing Texas and lower southern states in the US. He brings a wealth of knowledge and experience to the table with the background in data analytics, economics, and urban planning. Colin also holds the bachelor's degree in government from New Mexico State University and received the Master's of Public Administration in urban planning from the University of Texas in El Paso. He and his family resides in San Antonio, Texas. So now, without further ado, let's welcome Mr. Colin Sherman as he shares his insights and analysis on the current state of the hotel industry in 2024. Colin, the floor is yours.
Thank you, Rav. And good afternoon to everybody. You can hear me. Just make sure all the technical stuff is all right. We're good. Let me just share my screen here. Give me 1 second. Sorry, a little delay here. Apologies. We had it up earlier. Give me...
Technology, you love it, you hate it, right? And that's how I am.
Well, it was going smoother earlier. I don't know what happened, but
okay, that's all right.
Let's see. Okay, here we go.
Got it? Okay.
Yeah, put it in a presenter view. All right, and let me know if you can see this.
I can see it.
Okay. All right. Thank you for that great introduction, Rav. I appreciate it. And thank you for inviting me to speak to all of you. I'm going to have a fairly brief presentation because I'm excited to get into the conversation, have a little bit more informal meeting here, and also get to your questions. So essentially, I'm just going to quickly go over what the U.S. economy looks like as far as hotels and the hospitality industry, tourism overall, and then I'm going to get into the forecast. I'll probably spend the most time on the forecast portion of the presentation, and then we'll get into the conversation.
Sounds good.
Yeah. So first off, and I mean, there's really nothing I can say that you probably don't know if you're working in hospitality. We are seeing a trend of normalization among U.S. travelers, which means that in 2022, as we kind of broke out of the pandemic, we saw this huge surge in travel. People had a lot of pent up travel demand. They wanted to get out there. They had money to spend. And so we had these huge surges in hotel performance. It wasn't until about 2023, about April, maybe through May, that we started to see travel patterns normalize. And this is what this chart really reflects, is that RevPAR growth has fallen below the rate of inflation. And it wasn't just the normalization of travel patterns. We also had some economic changes as well. Again, inflation was a major part of that. We saw inflation rise. We had higher interest rates. Just kind of economic uncertainty really brought down those travel patterns to about normal levels. Now we've reached that point where RevPAR has fallen below the rate of inflation, as you can see here, and there has been a little bit of growth in February. I'll get to that in a little later in the presentation. Room demand, just as I said, also has been near pandemic levels since about well, looking at December 19, which is what this graph has been formulated to. We're just right there. So if you went back to 2019 as a benchmark and you were looking at the industry and you were comparing it to today, we're just below that 1.31 billion demand mark. We're at 1.28 for February 2024. Demand obviously has weakened this year every month since April 2023. I think this chart somewhat speaks for itself. It was from that surge about February, March that we started to see it soften, and then really April, May is when it started to decline. That is a product of not only some of the economic uncertainties that I spoke of earlier, but also we had major outbound travel. Which was a major factor in tourism as well, and hotels kind of losing that demand. So if you wanted to say it, 2022 was kind of this domestic travel surge. 2023, we saw a lot more outbound travel. So we saw U.S. Citizens going abroad, cruises, things of that nature. And so that demand really kind of softened throughout the entire year. And we're still feeling the effects of that. As you can see in February, January of this year, we're still a little below. We do expect that to go up in the year, but again, I'll get to that a little later as we go over the forecast. Okay. So a lot of the drivers I've been talking about, and you're going to hear me say this a lot, is normalization and other economic uncertainties, but we're going to kind of jump into some of those economic uncertainties and what's kind of been driving this demand softening. We can see here that the labor market is still healthy, but if you were to look at job openings and total employment from January 21 to January 2024, you can see the job openings are slightly going down, and we're also starting to see layoffs go up. Although the total employment has remained healthy, we're seeing the labor market starting to tighten through the course of the last year. Another major factor is is savings. There was a lot of savings from starting in 2020 to about 2022. Gross savings in trillions, as you can see here, but also bank deposits have down. So the percent of disposable income that majority of families would spend on travel is also going down, and you can see that in the top levels of the top 1% all the way down to the bottom 20%, that those bank deposits are going down.
I mean,
which is
if I can ask a follow-up question.
Yeah, go ahead.
Just because I know, after COVID, there's so much money that was given, right? And so people had savings because people got a lot of money. Are you saying that money is now sort of tapering off and it's being spent?
Yes, and also one other factor that, if I can add to that, so yes to that question, but also student loans came due in October last year. So you're starting to also see people having to pay those back. Again, adding to that less disposable income and travel. Um, as we kind of go through this, you'll start to see the theme that we're really starting to see that divide between those who can travel and those who had the luxury to travel but don't have it anymore. And that really kind of comes down to what these bank deposits and what we're looking at as far as disposable income, and what it's going towards, as far as even in classes of hotels as well.
Okay.
Thank you for that question. And do stop me if I'm being unclear. I tend to rush a little bit.
Absolutely.
Um, Again, accommodation spending at or above, spending on all services is up. This really is a product of really those who are traveling. We're, like I said, we're starting to see that divide between those travelers that are on the upper end scale of who are staying at upper end hotels, which are usually related with those who have the means to do it, and those that are traveling for business. That's why a lot of the adjusted spending index you're seeing here is on the rise, particularly in the services and accommodations area of the economy.
Mhm.
Oh, one other factor that is a significant contributor is that we're starting to see credit card debt go up substantially as well. It's raised just below for February. It's kind of softened a little bit as we got into the last quarter of 2023. But yeah, the credit card debt is going up year over year over year, which this is another indicator of the less disposable income. People are starting to put more travel and things on credit cards,
Mhm.
upping that debt ratio.
Absolutely.
I mentioned this earlier, but outbound travel is accelerating. Last year was kind of surprising. We saw those who are traveling are choosing abroad. That is a factor of having a little bit more savings, but also I kind of feel like they were, it was like, okay, we're going to test the waters by in 2022, test the waters by going to, our domestic travel. And now, as we kind of got and felt safer getting out of the pandemic, now they're like, okay, let's go outbound. Let's go to
Right.
Europe. Europe is discounted, and so let's go over there and really kind of test the waters a little bit. So we did see outbound travel really, really rise, and that was a huge indicator as well, of some of the softening that we've seen in the last year.
Mhm.
So kind of jumping into where the RevPAR has declined the most when we look at classes. What we kind of see here is a bifurcation, or really kind of a tale of two cities, as the upper end of hotels are doing well, and that's luxury, upper upscale. Um, this is just for 2 months from January to February, but the story played out the same in 2023. A big product of why luxury upscale and upper upscale classes are doing better is we've had this return of not only high-end leisure travelers, but also corporate travel.
Mhm.
So business travel or corporate travel took a hit during the pandemic years. It's been very, very slow to come back. But now, as a product of things are getting back to normal, we're starting to see the business side of things come back. And business travelers tend to stay in upper upscale hotels, luxury hotels that are associated with convention centers.
Mhm. So that's a great, if I may ask another question here, because I know, we've all talked about the fact that people are just staying home and the industry changed after COVID. Businesses were okay for employees to work from home. And more we're seeing where bigger companies are letting their employees now come back. So we're seeing a shift that's happening. Or obviously, I think our habits are changing throughout the world, not just in this country, where people want to stay from home. And now there's a mix of maybe going in a couple of days, then coming back to work, or staying home a couple of days. How do you foresee? And I know this is more of a foresight question in regards to just overall economy itself, but how do you see that shift playing out in the next couple of years? We're already seeing that shift in this data where before the luxury hotels were not performing well, and now they're starting to perform well, just because the fact that more business is starting to move around, more meetings are happening throughout the country. We're seeing the CBD, the Central Business District, which was lacking, which was hurting a lot. Now we're seeing rooms being filled all across major metros in the U.S. How do you foresee that in the next maybe 12 to 24 months?
I think it's going to continue. Business travel, and I hate to really talk about to say it, but there has been a return to office, and it's been a very that's a there's a relationship between business travelers and that return to office policy, and you're starting to see more and more companies and corporations have policies that are pushing their employees back into the office,
Mhm.
which means that there's more travel. That's not saying that they're in the office 5 days a week. Many of us still, have our Thursdays and Fridays, which do offer that to what you're saying. What I'm going to coin is bleisure travel, where we go for a business trip, we go for a conference, and then we decide, oh, well, let's take the weekend since we're here and invite the family up. We're seeing that still kind of the norm. We don't at the moment. We're not seeing that really dissipate in any way. We're starting to really see the those shoulder days of Thursdays and Sundays continuously pick up in the and I'll say it here is the bleisure category, and bleisure is business and leisure to
Mhm.
define it. So,
Mhm.
does that answer the question or?
No, it does. It does. I was just curious to see, what's happening because I'm hearing the same thing. And obviously, we're seeing data where a lot of the major hotel companies are also putting in other segments in terms of hotels in the market. A lot of extended stay came in the market in the last couple of years, for that business segment where they know that people are going vacationing and working at the same time. So if I'm working in a very flexible company where I can log in and pretty much work from anywhere, then why stay home, right? I can now travel and go to another place where it's a home away from home for one purpose where I can do the leisure activities, but at the same time I can log in, spend my 3 4 5 hours that I need to show my boss that I'm actually working. So we're seeing a lot of that trend that's happening in throughout the world, not just the US.
Mhm.
We're seeing data from all across the world where this shift is happening, but how long will that be sustainable? I think that's the question. So that the term that you said totally makes sense from a business and a leisure perspective.
Yeah, I think it also depends on the type of job or position that you're into. If you're working for a big corporate company and you're facing these back in office policies, that's going to very much affect of how your travel pattern. And then if you're still in that remote area of working, then yes, you're going to have the freedom to work anywhere. So I think it also kind of, in a way, patterns what we're seeing here on this chart is kind of that bifurcation of classes, right? So it's really kind of the bifurcation of what kind of position or job that you have.
Right.
But still, compared to 2019 and years prior, that is still very much a part of the business or corporate travel trend.
Okay.
Um, just to kind of look back at the chart on the other side, lower end properties, excuse me, got closed, or we saw a lot of lower end properties of economy get closed, or many were getting converted into multifamily. The economy sector is losing demand and losing rate and is not doing very well at this time. We don't see that changing in the near future. That's why we propose that RevPAR is forecast to lift only 1% for the economy sections or lower end. This could change as we are only in the first half of the year. It's really hard to say what that's going to look like by the second half. But as I said, the RevPAR forecast kind of shows that that'll only lift about a 1% for the year.
Mm-hmm. Yeah.
Um, oh,
Go
go
ahead.
ahead.
Now, I was going to say, we purposely invited not just transactionally brokers who are on this call, but we have a lot of owners, folks who own all segments from luxury to economy, on this call. And so, if I'm, I guess if I'm a hotel owner who has a mid-scale and economy flag that I'm not seeing a lot of growth that's happening. Um, then what would be your advice? I guess in one sense, I would say, am I seeing that I'm stagnant for the rest of the year, or there's still, I mean, we're still in the first, second quarter of this year. There's a lot of growth that will happen. There's a lot of stuff that's going to happen in the economy based on what's happening just nationally in the news, in the capital markets and all that. But if I'm an owner of these, this scale, mid-scale economy class, what would be your advice to me?
Ooh, that's a tough one.
Yeah,
I'm not usually in an advisory role,
right.
but I think the ability the ability your ability to change your rates every day is is a key priority.
Hmm.
I really don't have advice on that side of things, and I know that's probably what most people don't want to hear, but not really offering anything constructive. I don't really have any advice on that.
No, but what you said is so great though. I mean, you got to be vigilant. You got to, it's not status quo anymore where you were doing business the way you were doing before. You got to be more creative. You got to be more on the edge in terms of just looking at where your business is and how you can get more business. And so I think what you said was great in the sense that if I'm a owner of mid-scale economy segment and I'm seeing these numbers, yeah, well, yes, I am worried a little bit, but at the end of the day, I also know that I have now my work that I have to do, right? That fair share work that I have to do to maybe capture some of that business that before I was status quo, just because the business was coming to me. Now I have to go to the business to get the business.
I guess creativity is the word. Is the
Yeah.
word. Be
Yeah.
creative.
Right. Right.
The demand loss was driven by when we look at overall demand, the loss was driven by this decline in the lower class hotels, particularly economy. Like I said, a lot of it's been because we saw a majority, I mean, not a majority, but a lot of these close or be converted. So that's really kind of explaining the drop. That's not saying that you know, um, I wouldn't say that it was because of operations or anything like that. It was because they simply closed um, or they were converted. And this is
Okay.
also in much larger markets. Your Chicago's, LA's, New York's, um, and not necessarily in some of your smaller ones as well.
Mhm.
So,
And we
which
saw a lot of that. We saw a lot of that, the adaptive reuse that happened that you're talking about, where they got converted from use from hospitality to multifamily, from hospitality to maybe other asset class. And we also saw that there was a growth happening where a lot of these hotels were picked up by the city and the county and the state
mhm,
to provide alternative forms of housing, which is still a big issue, overall in the United States. But we're seeing that. So my background in in San Antonio, my backdrop in San Antonio, we're seeing even in the downtown market, a couple of properties were picked up by the city itself, and so nonprofit organizations came into play, city came into play, and so they either leased it or they bought these properties for homeless centers or for some other type of usage at that point. So we're seeing a lot of creative use being happening in properties. We have a client that's looking at selling a property to elderly care sort of business. So they'll sell their property because the occupancy is not there, and obviously RevPAR growth's not there in the submarket that they're in. So looking at creative ways, as we were talking about earlier, they're looking at partnering and also bringing equity to the table to creatively do a deal where if the city allows it and there's plenty of parking that's available, where now another company comes in, reinvests capital into that box that they have, and then it'll be a different use type at that point.
exactly,
Yeah.
exactly. Just a fun fact too, excluding the economy chain scale, industry demand was up about 2.7%. um, excluding Q1 demand without the economy class, which increased nearly 1% year over year. So if you take that out, RevPAR was up 2.7%. Okay, next slide. I think I'm frozen. Okay, there we go. This just kind of gives a little bit more evidence to what we were talking about in the economy scale changes. The left chart here shows the conversions, new conversions out, and then the ones that were permanently closed. And then also we have the economy supply and the number of economy hotels, which, as you can see, has rapidly declined since 2019.
Mhm.
Not rapidly, but more than we'd like to see.
Right.
So we're at much lower numbers of those economy scale groups, so, or
Okay.
brands.
Right. And this, as you pointed out, happened because of a lot of the factors, including some properties got closed, some got reuse changed, right? The business changed on that property itself. And there's not a lot of new properties that are being built at this point right now, just throughout the United States. So we're probably
Exactly.
seeing that shift happening because of that.
There's so many combinations and factors that have
Mhm.
affected this that, yes, and that's one that I'll bring up later, is that
Okay.
uh, is just not only the conversions, but yeah, those other factors as well.
Okay.
Uh, so kind of moving on, and then again, just to kind of show the point of where we are, the economic realities are also playing a role. The inflation adjust total of debt, which we kind of touched on earlier, and then the 90 days plus credit card delinquencies, which has been indexed to 2019 on both charts, just to kind of show how exactly where we are as far as those increases from 2022 and even prior to 2022, 2019 through 2020. So all this just is to just kind of show and prove that point of, we are, yes, normalizing, um, just from the surge, but also there are some major economic factors that are affecting families and just households in general.
Mhm.
Um, Now, I feel like I'm painting a very, I guess, dim picture of everything. The forecast will hopefully pick everybody's spirits up a little bit.
Awesome.
This was just an extra slide or chart I had, just to show the upper tier brands that are driving the demand growth, and just kind of showing by scale where, month to month, where they all kind of fell as far as where demand was really going. So you're really starting to see, again, your luxury, upscale, upper mid scales kind of be more prominent, and, or I'd say, consumer choice, as we kind of got through April 2023 at the end of the surge, and through February, which we're continuing to see. And I will say that those with the means to travel will continue to travel, and then also business travel, which is really driving that market. That also goes for group travel, which I'll kind of hit on here in a little bit too. All right. Hopefully this is where I'll spend most of my time. This is the good chart. This is the one that we all kind of want to see. So overall, we project industry growth. The two numbers you should be thinking about, though, when you're looking at this, is GDP, how the American economy will be expanding, and then also CPI, your Consumer Price Index. And that, what that means is how things are getting more, or what things and are getting more expensive. We believe that as GDP grows, so does room demand. And as CPI grows, so does room rate. So because as an industry, we change our rates every night, we kind of have an advantage to this, to kind of go with our GDP and also CPI overall in the US. The CPI impacts operators' feelings about how things are more expensive, so that they can increase or decrease their room rates. So what we're proposing is that there is more GDP growth in the future and more CPI growth in the future, which means there is more occupancy. We'll see occupancy raise, or I should say occupancy growth, and also some more pricing power as well to operators and owners. This translates to more RevPAR growth, obviously, which we project at 4% this year, and then slowing around 3% for the next couple of years. So really, instead of normalization, we're probably going to hear the buzzword of stabilization.
Mhm.
But there is this term of real RevPAR, and adjusting for inflation and looking forward. As we do so, we're still a little below where we want to be. Um, we should, we'll probably keep pace, but we'll still kind of be below in real form. Um, So this is something that we as industry watchers are aware of as things are getting more expensive for operators. So for flow through, in other words, what falls to the bottom line is kind of what's on every operator or hotel owner's mind. And top line, though, we say that 4% is the projection, but people are likely wanting to talk about profitability. Those are kind of conversations that we continue to have. On this front, we do adjust our forecast on a monthly basis as the data actualizes. So that's what you see today could change a little bit as we kind of go through the year. As I said, we project growth, so these numbers may change for higher percentages as well, which is great.
Yeah.
On the larger front, on kind of what the larger brands are saying, um, this is another reason that our forecast is so bullish on higher end. Brands are telling us that group and business is super strong, which indicates that upper tier hotels are going to do really, really well in the future. Um, as you can see here, Hilton Worldwide says that 2024 group positions are up. Marriott International, they're at their earnings call last quarter. Group pace is really still a very strong number. And then my favorite is what Wynn Resorts said, and they used the term super strong.
Yeah.
So yeah, that's something to really hone in on, that we are that, and one of the main reasons why we are saying that there will be growth and that will come down. So
Yeah. And when you mean, or when they all mean group, right? I mean, because consistent thing here is groups. Are we talking about on the business side, or are we talking? What are we talking about? Just so you know, because we have
yeah,
so many people on this, on this meeting today, and they're coming from different backgrounds, different diverse areas. So just want to
yeah,
make sure there's clarity there.
yeah. So we have and we have our leisure travelers, and then we really have well, I'll break it down into this. We have leisure travelers, and then we have our group travelers.
Mhm.
Group travelers are 10 room blocks or more. So those are usually the travelers that are traveling for, I feel like I'm saying traveling a lot. That are traveling for conferences,
Yeah.
conventions, and just large group meetings. If you think also of Nashville, it's not necessarily conventions or conferences. It's also bachelorette parties or
Yeah.
things like that. People that are traveling in large groups. Those have made a massive comeback in the last year. During 2020 and all through, I would say till the end of 2021, we saw a lot of group bookings postpone till the next year or till 2022. And then they all kind of flooded the market. So group has done really well.
Mhm.
Group is also related to business travel as well. As you know, companies send out, I don't know, a majority or a good portion of their employees across the United States to different conventions, conferences, large meetings, quarterly meetings, things like that, to different markets across the U.S. And then when we talk about leisure travel, that is your individual travelers. Those are your family travelers. Those are you and I going out on the weekends to go visit another market.
Mhm.
There's another way to kind of look at that too, and if you wanted to get more specific, you would look at midweek travelers and weekend travelers.
Right.
Midweek, again, is associated with group and business, and weekend is associated with leisure.
Leisure. Yeah.
Yeah, so that's kind of where we're I guess that's where we're really kind of saying is going to be strong, is on that group and business side, which has been lower this last year, or has been slower, I should say, to come back. So we're really saying that this year we're going to start seeing them return back to normal. Leisure demand has always been, it's been okay in the last 2 years. It's been driving a lot of markets. I know in San Antonio, it's been driving the leisure market, or the leisure travel segment has been driving demand, and
Mhm.
group has actually been lower. But we're starting to see group bookings to conferences come back, so that kind of helps dissect the what I'm talking about here.
It totally does. And thanks for explaining that, just because I think it gives a context, people get on the same page at that point. So it totally makes sense. And San Antonio, like since you mentioned that, cities that are more destination oriented cities where, people have to travel to get there for doing something. With San Antonio, it's the Riverwalk or it's the SeaWorld or whatever, where people have to physically come in here to enjoy that venue, enjoy that space. We're seeing that travel go up, the leisure side go up, and then but in some other places where groups are going to be strong, as you're indicating on your side here.
Yeah, so it's really coming back to groups and business. Like I said earlier, leisure is starting to feel that kind of pinch from the economic factors, and so
Mhm.
leisure is really kind of softening a little bit from last year. So the real strength is going to come from the corporate travel and the group travel
Yeah.
back to markets. I think on your point, though, San Antonio is very much a leisure and group market. Dallas is a little bit less leisure and high on the business side of travel. Just to kind of give an example of two cities and how
Right.
they differentiate.
Makes sense.
Um, so uh, this is a real fun slide. I just wanted to show what markets have grown in the last year, and as of February 2024, this is actually year to date, so it's really only 2 months of the year. But as you know, if you look at the top of this list, you see Las Vegas. There was an Usher concert there last month, I think, to be followed by a small little football game that was played. Not sure if you saw that.
Yeah.
I'm just kidding with everybody. But we had the strongest continental ADR for any market on that Sunday night. The average room night, this is just for fun fact, the average room night was $800 for the market. And
Mhm.
because also the length of stay requirements for 3 or 4 nights, that was bumped up to $2,000, $4,000 of daily rate. The Las Vegas data was so strong that the February RevPAR for the nation was up 2%. So Las Vegas moved the nation 2% in RevPAR. If you exclude Las Vegas, it was actually down 1.4%. So
Mm.
Vegas holds about 3% of the nation's hotel inventory. So just that night alone swung the national average by 2%. That's pretty incredible when you look at it. There's not much else to say on this chart. I really wanted to just kind of hone in on where that that in February Vegas was strong, so strong it moved us and it moved all markets, which was kind of crazy. It's fun to think about. But if you were to just kind of go down the list, you can see where most RevPAR growth has been. Some of our Texas markets, and then obviously some of the larger markets that we all know well. Your Houston's, your New York's, your Chicago's, Washington D.C.'s. We did see a little bit of downturn in other markets and RevPAR, but that's fairly normal for a year to date February data set. So we should see that pick up once we get the data for March. But this is kind of where the nation stands at the moment.
It's very interesting.
To jump into the pipeline, there's not a lot happening. This is in thousands, by the way. So what's in construction is not going to move very much, but the planning numbers did go up 50%. This is truly a cause of interest rates and tighter lending. Um, we're starting to see a lot of projects that went in final planning stay in final planning, and a lot less projects go into construction. I'm sure there's a few of people on the call that are possibly going through the lending process right now, and we all know that they're requiring a lot more capital to be put on the table to get the deal done versus, you know, uh, I guess taking on the lending standards that we were so used to a few years ago. Um, So this is kind of our forecast for the year, is that unless, we could see interest rates drop, which we do expect, not significantly, which could move a lot more of these projects into under construction phases. But at the moment, this is what we're seeing, and we're expecting planning and final planning projects to stay there.
Yeah.
Which is it's kind of ballooning at the moment. It's gonna be real interesting what happens if interest rates do lower, and kind of see what happens. So
Yeah, I mean, we have a lot of agents on the call, and obviously a lot of owners, who are going through some of these challenges. And I can tell you, as a broker, we've seen our numbers go down, and the reason for that is primarily it's not access to capital, it's not access to inventory. There's inventory out there. It's access to the money itself, the capital itself. And so we're seeing challenges where even on the new supply side, even people who were proposing new construction even a year ago, lenders just walked out. And
yep.
so finding new debt, and even if you find new debt, the LTV's changed where now they're requiring more down payment. And so whereas, before it was whatever, but now, for somebody to bring in 20% more equity to the table to get a project done, it could be a deal killer, right? And so
Yeah.
now they have to look for alternative sources, or maybe bringing in bridge or mezz lenders to the picture and pay higher interest rates to get the same thing done. And so a lot of people are just saying, look, should I just wait if I can wait? And then see what happens after 2024 and beyond? Or do I do this and not make a lot of money as I was projecting, knowing that beyond 24, things will change. And if it changes, then you can always refi and do whatever you need to do at the end of the
Hmm.
day. So, but those are real discussions and real things that people have to make decisions on, in order for them to survive in this market.
Exactly. You said it perfectly. Yeah, that's really kind of the sentiment of the industry at the moment. I think that though we are going to see we're starting to see banks and also buyers kind of come to terms with the new economy.
Mhm.
Um, I, we without saying this definitively, don't quote me on this, but I think this year we will see a lot more CMBS loans go through.
Mhm.
Um, and that because of the larger lending banks are willing to work with buyers. That's kind of what I've been hearing, which is good. Um, but again, we are still holding our breath for the Fed to rate or to bring
Right.
interest rates down.
Down.
So,
Yeah. Yeah.
which again, that might be holding our breath a little long till we're blue, but we're hoping for the best.
Right. Right.
So, um, again, just kind of going transferring from pipeline into the transactions. Transactions didn't really happen last year. Overall, we're down about 50. The U.S. is down about 50% from a year ago. We expect to see more, but it'll be backloaded as the Fed might cut interest rates, which would spur some activity, which we're expecting it to. This is kind of interesting too. If you are potentially a buyer or an investor, this could be a good thing, which it is, or it could be a bad thing. Right now, because the interest rates are a little bit are higher, we're starting to think that, hey, there's probably deals to be made, because once the Fed cuts those interest rates, you're going to have a flood of buyers enter the market, and there might not be as much opportunity as there was at this time. That's not a piece of advice at all. That's just kind of what I was hearing as I was at a recent conference. Um, and that also kind of correlates to where the lenders are, and also where they're starting to just say, okay, we're adapting to these new financial situations, and we're ready to kind of listen to interested buyers and see what kind of deals are on the table, maybe work with them a little bit. Um, so again, this conference I was at was the Hunter and Hotel Investment Conference.
Mhm.
There were a lot of investors there, and a lot of investors. Just the general sentiment of the entire conference are eager and willing to wheel and deal um, with buyers and sellers. And I do think sellers are finally going to come to the table to talk about what prices are looking like. There was a lot of talk about pips. A lot of the big brands are pushing, or I guess putting downward pressure on property improvements, which is kind of you know, giving owners this option of, do I incur more debt or do I sell? And so we're kind of expecting that to maybe open up a few more deals in the coming year. We'll see. There's, again, nothing is definitive, but that's just kind of the talk that I've been hearing within the industry.
Yeah, thanks for mentioning that, Colin. I mean, practicality wise, I mean, if you think about, and this is what we're seeing, buyers, when we're engaged with buyers, we're basically seeing the same thing, even though the bid ask spread is so huge where buyers on one side, sellers on the other side. But practicality wise, if the seller needs to sell because their SBA loan went from 5-6% to 9-10%, right? They can
Hmm.
only survive till whatever time period they're going to survive, and after that something's got to give, right? Either they inject more capital into the business itself or they need to sell. So that what you're talking about, the fact that you're out there at the conference and the investors and the buyers and sellers are having these deep discussions, and we're seeing in the industry the same thing where people are engaging, people are talking, and people are now trying to get these deals done, which if you asked me a quarter ago, I don't think that was happening as much. It was, I mean, business will still happen,
Hmm.
but the transaction volume suffers accordingly, as you're seeing in your charts itself. But encouraging thing is that we're seeing people talk, and I also see this as an opportunity where when the interest rates do go down, as you stated, and then at that time, the flood of investors open up and buyers come in. I'm not sure if sellers would be as keen to discounting than what they can probably today, just based on the sentiment, based on what's happening in the market at this point.
Yes, exactly,
Yeah.
exactly. I'm almost finished, so I did want to promote our national directors podcast. For it, you can find it on any of your podcast apps, Apple, Spotify, whatever. Uh, our national director, Jan Freitag, who I work closely with, and our vice president at STR, Smith Travel Research. They do a monthly podcast on the hotel industry at large. It's a lot of fun stuff. It's a lot of real stuff, and they really capture what's going on nationally and what's happening in markets. I encourage everybody to listen to this. It's an hour long, depending on how much they have to say. Sometimes it's 30 minutes, but it's a really good podcast to really kind of just dive in and really hear about the data and hear about what's going on. So it's called Tell Me More. And it's like I said, it's on Spotify, Apple, any podcast app. So you can find it there.
Awesome.
That's all I have. I hope that was somewhat informative for everybody. I'm not sure, but I hope somebody took, all of you took something out of it. And obviously, my contact information is here. You can email me. That's probably the best way to get me. I can also, and once you email me, I can give you my direct line if you have any questions, or you have any questions over the data that CoStar provides through these sessions, or any session that you see CoStar data, or some of you may be CoStar subscribers. Please give me a call.
That's great. Colin, I have just a couple of follow-up questions. I got a couple of texts here, which people probably didn't want to write on chat, but I encourage everybody. We have about 5 minutes. If anybody has any specific questions, if you can just type in the chat area, we'll be able to take those questions. Now, we were talking the other day, and with a couple of the buyers and sellers, I think regarding how is technology and AI changing our world, meaning our hotel world. And so if you want to maybe talk about, because your background's in data analytics, right? And you're looking at business intelligence, how is the role of technology going to play in the hospitality industry in terms of transformation?
I will say off the bat, I don't think we're all going to be replaced, which is good.
Yeah.
Um, I mean, just in my position, I've been fearful of it a little bit because the way that AI processes data is pretty incredible.
Hmm.
But what I realized is as I do talk to hotel operators, and when they talk about AI entering their operations, it's not so much a replacement as it is an assistant. If you can have an AI system that can give you, I guess, analysis of your rates or of your RevPAR or even comparisons to other markets. I think that's very, very helpful, because what it's going to cost you to get an analyst to tell you that is you're it's going to be a lot. It's going to be it's going to take up most of your budget.
Hmm.
So I think that AI is nothing to be scared of if you look at it as an assistant. I will say from my perspective too, and just also in the hotel industry, we're starting to hear a lot more people use it. Our industry here at CoStar and real estate is using it currently, not necessarily ChatGPT, but a form of it, and that is to help us also analyze data,
Hmm.
um, answer simple questions. It's really kind of dispelling. I would like to dispel that mystique behind it, that it's going to take over people's jobs. I'm sure it will in some cases. If you're a if you're a copy editor or something, it might. But in the hotel industry, I think it's only just an assistant, and can actually help hotel owners and operators do their job and do it more proficiently.
I agree. I think it is a tool, and that has to be looked at as a tool itself. And But that tool could be very efficient. It could be transformative in terms of providing the information that you need on a daily, on a hourly basis. So I think a lot of people are deploying these tools in their everyday business practices. It's hospitality or not. I mean, us as brokers, people out there using that data, whatever that data is. I think the crunching happens faster. So for so definitely, I think technology is playing a very crucial and important role in the hospitality industry. There are some people who asked questions regarding, um, you know uh, when you're a buyer and a seller, you try to time a market to see if they can exit the market or enter a market at optimal time. What are we seeing in terms of trends in 2024 in regards to, if I'm a buyer, should I be waiting? And I think we already answered that question a little bit earlier when we were talking about the fact that because debt is still high and there's not a lot of buyers on the table, sellers are willing to listen at this point, and they're willing to negotiate a little better. The question was regarding just timing itself. How do you time a market? And is there a way to time a market?
I don't think there's any way to time a market. The short answer, I think you just need to look at your what you're willing to put in. I mean, if you have the capital, you see an opportunity, you've done your due diligence, I think that's the time to enter. And like I said, I don't think there's any great time. I don't think there's any time that is. It's just, it really comes down to your individual operations and how and where you see the opportunity, and really, if you have the capital, if you have the lending, it makes sense. And I think really, I'll say it one more time: due diligence. Look at it. Look at your comp sets. What is the market doing? What is it looking like? Are there drivers in the market that meet your particular needs? Um, I think that's just kind of your up to the buyer's considerations. Like I said earlier, I don't think that if you looked at this time on paper,
Mhm.
at least now, it looks like a time to buy. But 6 months from now, you could say, dang, I should have really bought, because now the market's open, rates are lower. I had that opportunity and now I don't. And so
Yeah,
there's going to be competition. So
yeah.
and I'm not saying that this time is a good time, but you just kind of need to look at your books and talk to your financial people and really kind of hone in on what it is that you're looking for, what's going to be of value to you, and where you see the opportunity.
Agreed. I think it's all about perspective. It's all about due diligence. One of my buyers told me just yesterday that I wish I would have bought right before or during COVID time period because everybody was scared. And but he said I was scared also. I didn't know what was going on, and I didn't transact. And right after COVID, this the hockey stick curve. Everything just shot up, and but I could have had some discounts. Similar discussions people are talking about today, saying that look, if I can negotiate something better today and enter a market, I think anything beyond that, once interest rates change, once from a national perspective, the elections are over, and we look beyond 2024, maybe 25. People are calling survive till 2025. I mean, there's so many things that people are looking at. Is that everything that we're buying today will be more expensive tomorrow, and that has to do with the presentation that you just gave in regards to, yeah, expenses are going up, but so does the ADR, so does the RevPAR will eventually lift up and go up to catch all of that. And so whatever we can, negotiate and get today, possibly maybe productive and could be better than tomorrow, just because then everybody else will be looking at it, supply and demand issues. But Colin, really want to thank you for spending the last hour with us. I know you're a busy man, you travel a lot, and I look forward to meeting with you personally one day. But I just want to say thank you again from the bottom of my heart to present the data that you have, that you see in the hotel industry, and you're willing to share. A couple of slides, a couple of people asked regarding slides. Would it be okay if you email me those slides so then I can forward it to the rest of the
Not a
gang?
problem. Yeah.
Okay. Well, with that said, I want to thank everybody. Thank you for your time also to spend with us. Remember, as we said, this is going to be a quarterly discussion. It's more of a discussion than anything else. We'll bring in other thought leaders. We'll bring in other folks who can elaborate on what's happening in the hospitality industry. So please stay tuned. Stay connected with us at singcommercialgroup.com for more insights and more opportunities in the hospitality industry. And with that said, I want to wish you guys all the best. Happy holidays, and then also happy weekend. I hope you guys have a productive weekend. Thank you. Bye.